Joining me now, John Petrides, portfolio manager at Tocqueville Asset Management. John, great to have you on. Thanks so much for joining us.
Thanks for having me on, Caroline. Great to see you.
So, John, great to see you as well. Should note that stocks are kicking off the first full week of April with some green on the screen. Gains are pretty modest at this point, but how are you approaching the market right now? What are some of the catalysts that could move stocks this week?
Yeah, well, I forget about the week. I think it's moment to moment. Clearly, I think everyone's attention is squarely on what's happening with the war on Iran, the state of the Strait of Hormuz, and the impact to oil prices or energy prices, because clearly there's massive inflationary forces that the longer this goes on, the longer that the strait is closed, or that only a few vessels are slipping on through, the longer that commodity prices stay higher, the more pressure there is on inflation, which keeps interest rates higher globally and more stress on the consumer. So, that's where all the attention is right now.
So with oil, U.S. crude at $112 a barrel, and with the S&P 500 only less than 6% off the highs, do you think investors are underestimating how prolonged the Iran situation could be? I know there's hope for a ceasefire. We'll know more, potentially later this afternoon. There's a Tuesday deadline, so there's a lot of uncertainty still. Do you think that investors are underestimating the risk?
It's a great question, and we're almost 1 year to the day of where there was capitulation on Liberation Day. And then this idea of taco, right? Trump always chickens out. And I think that is very fresh in investors' minds. I mean, you had rewind to March of 2025 on the anticipation of what tariffs may be, the anticipation of what may happen in the global economy. And you had a very down stock market. And then, of course, we all know on April 2nd, the administration put forth significantly more draconian tariffs, potentially across various other countries, trading partners around the world, to 1 week later capitulating on most of those. And instead of an initial north of 20% average tariff rate, it settled out to around 12 or 13%. And now we know all of those efforts were now deemed to a degree illegal by the Supreme Court of the United States, and of which tariffs are leveled out to now about 15%. But the point is that eventually, 1 week after making an announcement, the administration capitulated and used those as negotiations. So I think part of the reason of why the stock market is not acting more concerned or worried, or you're not seeing more of a dramatic sell-off across the board, is mainly because they think ultimately there'll be some settlement where the strait will be open. Now, whether that proves to be the case, it's really hard to tell. But I think, to answer your question, that's why my assumption is that's why investors are more sanguine than what you would think, given the situation that we're in.
But even so, I mean, oil is now up almost 100% so far in 2026. At what point does that become damaging, even if the strait eventually reopens and we do see oil prices start to head lower?
Yeah, and it's not just oil prices, right? Look at liquid natural gas, which a lot of the East Asian or Asian countries really rely on. They're feeling that pressure. You're going to see rising prices in fertilizer and certain commodities like helium that are important through the supply chain, and obviously major impacts to inflationary costs. So, the longer that this drags out, the more impactful it will be on the economy. As of right now, my opinion is that the U.S. will not be in recession. But if we're still talking about, higher oil of north of $120, north of $130 come June, July, and we're seeing on a national average, $5 at the pump on gasoline, $5.50 at the pump for an extended period of time, then the whole math changes on where a recession might come into picture here. So
we also,
I think what investors have come to learn is it's not just one data point and you extrapolate that into the future. It's the longevity that we're at these higher oil prices. And I think that's what investors have come to appreciate over time.
John, we also have earnings season approaching. I know Delta's reporting this week, Constellation Brands. I saw Levi's on the schedule. So a slow start here. But does any of that matter for the market, or is this all about an end to the war?
No, all of that matters. It's tremendous, right? Because when you look at valuation of stocks, it's the typical way is price to earnings, right? So earnings is the denominator in that valuation multiple. And right now, expectations for earnings are actually quite healthy. Of course, that's driven by the Magnificent Seven. It's driven by the spending in AI. We've only really been at this pressure on the consumer called the past 3 weeks. So you're probably not going to see many companies cry uncle in terms of the pressure on their earnings, right? They're going to wait for more time, given that the quarter just finished. You're going to see, and so I think earnings expectations are quite robust. If the knees start to buckle on earnings, then you're going to see stocks potentially fall significantly farther.
So robust earnings expectations, no view that a recession is near, according to you. Are you bullish then in this environment, given the fact that, or hoping that this war sort of ends soon? Can you make the case that once that's out of the way, this is a market that can head higher?
Yeah, I appreciate the question. Let me clarify first. It's all yet, right? Again, the longer this goes on, the longer that commodity prices are higher, the more the more impactful it will be on earnings, the more impactful it will be negatively, obviously, on the economy. That then you're going to have all cuts will eventually follow across the board. You may even see more of a situation where if commodity costs or input costs or supply chain costs are elevated because of conflict and geopolitical reasons, maybe you see an increase in the spending on AI to offset labor costs, right? Maybe companies protect their margins, and you see an increase in the speed of adoption of AI across companies to offset margin pressure, and that accelerated what I think was a big fear during the first quarter of this year was some of the advancements that we were seeing out of Anthropic and OpenAI in terms of the impact that it may have on certain companies, and particularly in the labor markets. Maybe that it gets exacerbated, or accelerated, I should say. So I think right now the situation is extremely fluid, and the level of disruption is extremely high. And I think over the next 4 weeks, you're going to see all this sort of play out in almost in unison.
Okay, so how do you actually navigate this kind of environment?
Yeah. Well, one thing that we do for our clients in our portfolios as we pick individual stocks and bonds and we look for value is we've been advocating for a very long time to cast a wider net. Almost for a decade, basically, up until the beginning of 2025, it has been really a one-trick pony that has driven all asset classes, or has outperformed all asset classes across the world, right? It has been large cap, U.S. tech growth. And whether that was the FANG stocks, if you remember those, that passed the baton to the Magnificent Seven, it has really been a handful of stocks in one region of the world that has dominated all other asset classes up until about the start of last year. And we have been very vocal and concerned about concentration, and that the S&P 500 is a market that's supposed to capture a basket of 500 stocks to give an index of what an economy is, has really been skewed because it's been sort of 7 to 10 companies that have carried the whole ship here. And we've been advocating for investors to diversify. Investors have not been compensated for owning small cap stocks. They've not been compensated by owning value stocks. They've not been compensated by owning international stocks up until really the past, call it 15 months or so. And we still think there's value to be had outside in active management, in finding pockets where there is undervalued securities, mispriced securities, rather than simply buying the index, rather than simply buying a passive S&P 500, which is really skewed. We're in the most concentrated stock market, judged by the S&P 500, that we've been in history. So we think there's tremendous value to be had out there, but you have to sharpen the pencil and find it.
So dig in a bit more in terms of where you're finding value. You can't talk specific stocks, but sector plays that you like, that sort of thing.
Sure. Well, we're unconstrained investors, right? So we can go wherever we want. So we could start in the United States. It's been perplexing to see the sell-off in medtech. Looking at healthcare, healthcare has been one of the value sectors that has underperformed. You would think in an environment where investors are nervous because there's so many issues, whether it's the sell-off in software stocks, whether it's fears of credit contagion and private credit and what's going on in the private markets, whether it's the global geopolitical risk and rising commodity costs. You would think investors would fall back on defensive type sectors like healthcare, knowing that we have this growing baby boomer population, this aging population, the utilization of the healthcare system is only going to increase, and we've been really surprised by the sell-off in medtech stocks, or the underperformance, to use a better term. So there have been individual companies, U.S. based, where we find tremendous value on medtech. One way that investors can play it is to own the ETF. The IHI is the largest medtech ETF, I think, by assets under management in the world. So that's a way. Like you said, I can't speak individual stocks for compliant reasons, but I think that's an area where we're finding value. To continue the theme about diversification, last year U.S. stocks did fine. If you look at the S&P 500 was up something like 16% for 2025, but international was up like 30%, and emerging markets were up nearly 50%. And those two categories, international and emerging markets specifically, had been perennial underperformers of the S&P 500. We have been adding to that space, and we still think international is attractive relative to domestic on a valuation perspective, and we think emerging markets are attractive compared to domestic as well. Again, valuation driven. We like the north of south active emerging market ETF. The ticker is GEME. We own that for certain clients. I own it personally. And there are not many actively managed equity emerging market ETFs out there. Most of them are in the form of mutual funds. So here we think you get diversification through the ETF, you get liquidity through the ETF, and you get an active manager in an asset class where we think there's a lot of value.
Okay. Speaking of value, though, and bringing it back to tech, the Mag 7 could be looked at as on sale. They're all lower so far in 2026. I was just taking a look at how far they are from the highs. Apple only 10% from the highs, but you take a look and Meta is off almost 30% from the highs. Does any of that look attractive to you, just in terms of the Mag 7, as you think about value?
Yeah, it's a great question, because despite my concerns or fears about concentration of the S&P 500 driven by the Magnificent Seven, these are fantastic companies, right? This is not 1999. These companies have tremendous balance sheets, earn tremendous free cash flow, are dominant positions, have tremendous moats. I mean, they have earned the right to be on top of the mountain when you look at market cap weighting within the S&P 500. There's no question. But if for some reason someone watching this does not have any exposure to the Magnificent Seven group, and or is not overly concentrated across their own financial assets, then I do think now is a healthy time to nibble in to those companies. I do think that investors, going out in this broadening theme, into whether it's international or value stocks or different sectors, or energy, which we've talked about, which has rallied so much. Most of the market has been underweight energy companies. You have to sell from something to buy something else. And I think what you're seeing is not only concern about the future spending on AI, how sustainable it is, but also if you want to diversify, you have to sell from what worked. And obviously, the Magnificent Seven have been tremendous performers over the past, any metric you want to look at. And I think they've been sold here to be used as liquidity to buy and to diversify. So I think if you currently do not own any of the Mag 7, I think it makes sense now to be looking at that group, or at least maybe nibbling into your portfolio.
Okay, so consider med tech, invest internationally, specifically emerging, nibble on the Mag 7. Just to sum things up, the best advice for investors who are listening in right now thinking, Is the bottom in? What should I do right now? What's your best piece of advice?
Best piece of advice is really take a step back and determine what your objectives are. If you're a trader, right, this is a really complicated environment. It is really, really complicated because the narrative is changing on a daily basis. And if you're looking to make a quick buck here, or you're looking to get in and out of positions, good luck to you. It's really complicated. It's not the space that I play in. If you are an investor and you're willing and you understand what your financial objectives are, and you're looking to build wealth and hold, an asset class or a stock, and look out 2 to 3, 3 to 5 years in terms of a timeline when you're looking to make an investment, then I think there's clearly opportunity to be had here. And I think that the inertia, the volatility that we're seeing in the market, something we really haven't seen since this time last year. Outside of Liberation Day in 2025, the market by and large was relatively calm. Then these are opportunities to pick up some valuable franchises on the cheap that you could potentially grow a lot of wealth for you and your family. So that it really is determining who you are in this environment. If you're a trader, I think this is a really tricky time to invest. If you're an investor with a longer term time horizon, I think you're discerning enough. There's a lot of value out there.
Okay, I think this is a good time to pivot to our rapid fire this or that portion of the program. It's your first time playing, John. Are you ready? Quick questions, quick answers?
I'm ready.
Here we go. Lean in or play defense?
Play defense.
Safety in mega caps or value in small caps?
Safety in mega caps.
AI trade, durable or overextended?
What part? I would say durable.
Oil, temporary spike or sustained pressure?
Sustained pressure.
Geopolitics, noise or real market driver?
Real market driver.
Macro risk, inflation spike or growth scare?
Growth scare.
Recession risk, overblown or underpriced?
Overblown.
Wait for clarity or put money to work?
Wait for clarity.
If you could only own one sector for the rest of the year, what would it be?
Healthcare.
Because you like both, US stocks or international stocks?
International.
Treasuries or gold?
Gold.
Going back, actually, developed or emerging markets?
Emerging markets.
Election year, headwind or tailwind?
Headwind.
One word to describe how you're feeling about the market right now.
Confused.
One word to describe where you think the market will be by the end of this year.
Higher.
John Petrides, portfolio manager, Tocqueville Asset Management. Thank you so much for playing, for your picks, and for your perspective. Really appreciate it.
Thanks for having me on. This was great.